Simon, let me just ask what you expect from the ECB in light of the weakening European economy that we've been witnessing of late.
We're expecting, I think very much in line with consensus, further indications of easing coming, be it an LTRO or a further LTRO coming up, but also generally the suggestion that rate hikes expected, if at all expected, would be pushed back at least into next year, which would be following a similar narrative to what we saw from the Fed back in December, what we saw from the Bank of Canada, et cetera, further policy support for what's perceived as a generally weakening economy.
Simon, good to have you with us. So we talked at the beginning of, well, about an hour ago on this programme about whether the Goldilocks situation in markets that seems to be present in January and February lives on into March. Do you think it does, supported by that more dovish take from central banks globally?
Yes. Look, it's been interesting this cycle. We've sort of seemed to oscillate between policy driving markets and fundamentals driving markets. I think we're very much in a policy driven state currently. It was what led to the sell-off in markets in November and December, concerns over trade wars, concerns over Brexit and the impacts that had on the European Union, etc. The close down in the US government. Now there's more positivity. We had various quotes last week and various reports that we would have a settlement of the US-China trade situations. There's been various slight degrees of progress with respect to Britain's positioning and exit. So against that environment, if we look back at the first 2 months of this year, it was actually been the greatest or highest rise in the S&P 500 that we've seen since 1991. And somewhat ironically, when we've had positive January and February price appreciation in the S&P 500, which has happened 27 times since 1950, in 25 of those we've seen further appreciation over the rest of the calendar year. You put that against a backdrop of potential good news continuing with respect to the US and China trade situation, the general easing, be it from ECB, be it from the Fed, the support for the Chinese economy that we saw earlier this week, that we think will further support risk markets from here and equity markets move higher.
Where are your clients primarily putting their money right now, Simon? Is it, in terms of regions, is the U.S. still the best game in town?
It's interesting. We did see outflows from client accounts or from clients' portfolios in particularly November and December. There was a lot of concern that markets were going to deteriorate because of these policy concerns. It would leak into fundamentals and we'd actually see a significant downturn. With a turnaround in markets, which has recouped almost all of those losses since November, we actually haven't seen the same level of participation. Many of our clients that I'm speaking to are still wanting to see further confirmation that these policy concerns are being alleviated before reinvesting back into markets. The one area, though, where we are seeing a lot of demand is on the sustainable investing side. The one area that we've seen continued inflows, frankly, all of last year through November, December and all this year is our cross-asset sustainable investing portfolio. It was interesting, the last interview you did, you talked about pineapple loafers and even Mark, the CEO of Hugo Boss, was talking about sustainability being an increasing part of their business. Well, when we talk to our clients, sustainability is an increasing part of their portfolios.